All right. Good evening, everyone, and welcome to the Taurus Wealth monthly market review covering the month of June 2026. The past month capped off one of the strongest first halves that we've seen for global equities in years. And June itself, though, was a genuine stress test of that sort of resilience that we've seen in markets. A hawkish turn being seen from the Federal Reserve and a fast-moving flashpoint in the Middle East, though, that did try to briefly threaten and derail the rally that we've seen in equities. Over the next few minutes, we'll walk through what actually happened over the course of the month and then spend the latter half of the presentation on where we've seen some opportunities and the risks heading into the third quarter. So stepping back, June really was a story of two halves. Wall Street closed out its best quarter in 6 years, with the S&P 500 finishing the month around the 7,483 mark, the Dow pushing through to a fresh new record above 52,900 in early July, up nearing 3% in the month of June alone. Of course, the headline event was the Fed's June meeting with the Federal Reserve, where the incoming chair, Kevin Warsh's committee, held rates steady but set a marginally higher bar for further easing, and there was a bit of a hawkish tilt in terms of his rhetoric. He also did reiterate just last week at the European Central Bank's Sintra conference, warning that prices are too high. So definitely undertones of hawkishness being seen there. Layer on top of that, a fast escalating, then a fast cooling conflict involving Israel, the US, and of course Iran, and you get a month where volatility spiked and collapsed almost as quickly as it appeared. The VIX actually finished in June back near the level of 16, comfortably inside its 1 year range of roughly between 13 and 35. So definitely within the world of volatility, significant volatility. Focusing on to equities now, quite significant divergence being seen across the globe as well as across the sectors, even amongst the key US indices. The S&P itself ended down marginally, though the tech-focused Nasdaq was down nearly 3% for the month of June. Worth highlighting, though, that a lot of this drawdown was driven by the pullback in the Magnificent Seven stocks, keeping in mind that within the S&P, the Magnificent Seven stocks comprise of more than 30% of the market weight, while for the Nasdaq, it's upwards of 50%. And we'll touch on this more later. A few numbers worth putting on record here in terms of sector performance. The semiconductor complex capped an extraordinary first half, up more than 80% cumulatively, with AI chip revenue surging 74% to in excess of $18 billion. But even the biggest winners weren't immune to profit taking. Micron, for example, gave back over 10% in a single session in early July, despite still sitting on a year-to-date gain above 260%. The real headline, though, is small caps. The Russell 2000 broke through to an all-time high above 3,046 on 1st of July. That's its best first half performance since 1991 at roughly 22%, comfortably ahead of the S&P's 9.6% and the Dow Jones is close to 9% over the first 6 months of the year. Other markets were also quite mixed, reacting to the ebb and flow of the Middle East, with performances in the European indices up close to 2.73%, being attributed to lower commodity costs, whilst Chinese markets were buffeted by weak economic data, which doesn't help an already weak sentiment in the environment and the equity market in China. In the fixed income world and rates, June was a month of central banks pulling in different directions. With Warsh's first session as chair, we saw quite a hawkish tilt, as I mentioned, though this wasn't taken with too much as a surprise in terms of bond traders, as was seen by relative stability in the MOVE index, the volatility index of treasuries, which stayed relatively contained despite volatility being seen on the equity front. Away from the US and the Fed, the ECB's move to 2.25% was the first hike being seen since 2023, and the Bank of Japan's move to 1% took Japanese policy rates to their highest levels since 1995. Both signs that the era of universally easy money is fading, even as the Fed itself does stay put. In terms of the Treasury yields, the 2 year, the part of the curve which is most sensitive to Fed expectations, that rose to more than the 10 year, exactly with the flattening kind of dynamic that we would expect to see ahead of a more hawkish central bank stance. From a quality standpoint, markets continued to price in credit stability, remaining confident in corporate balance sheets and loan repayment abilities, particularly in the US and developed markets. Looking at other asset classes, commodities, I think it's worth putting some hard numbers on the reversal that we've seen in traditional havens and safe havens. Gold slides took it from north of $4,500 an ounce in the spring months of this year to briefly below $4,000, while the WTI round tripped from a wartime spike back down into the high 60s once the Strait of Hormuz returned and reopened. In the currencies world, the dollar index bounced back above the $100 handle as it experienced its strongest month in quite some time since March. The yen has also seen significant weakness, now pushed beyond 162, a genuine 40-year low that's putting real pressure on Tokyo and the BOJ to at least consider verbal, if not physical intervention. In terms of the digital asset space, we continue to see weakness, investors continuing to allocate capital elsewhere, and it's not just Bitcoin. Ethereum was also down 20%, Solana was also down 10%. So widespread weakness in digital assets. Sentiment has also genuinely been on a roller coaster over the last 3 months. Rewind just a month back, and this index was sitting deep in greed territory above the 60 mark on the back of an extraordinary first 4 or 5 months of rally. Today, it's back down in the fear territory in the low 30s, which tells you how quickly positioning has flipped, especially once the Fed's tone has shifted and the Iran situation has also flared. We treat any single reading that we see from this metric with some caution as a sort of contrarian buy signal. And often these sentiment gauges are noisy month to month, but directionally it does corroborate to what we're seeing in options and volatility markets. Investors have meaningfully de-risked into the quarter end. Sentiment has swung from greed to fear over the back half of June as the Fed's hawkish pivot and a rotation out of AI adjacent mega cap does continue to weigh on risk appetite. And this is a significant mark of reversal from the greed readings that we saw for much of quarter two's record-setting equity rally. And just a reminder for everyone in terms of the components of the fear and greed index, it isn't just one of these components which has shown weakness. We're seeing net new 52-week lows on the New York Stock Exchange. Stock volume in terms of breadth is also down, to be expected as we head into the summer months with a lot of traders going on summer holidays. And we're also seeing lower demand for call options, junk bonds, and in general risky assets. There's lower demand. Having said all of this, I wanted to spend some time highlighting that despite the pullback that we've seen on a broad index level, we still see some favorable statistics and metrics which point to long-term returns, specifically on the equities front. Both charts on this slide are telling a consistent story. The pullback looks like a well-worn historical pattern, not the start of something worse necessarily, and the labor market is continuing to do its job. In terms of the labor market, the initial jobless claims figure that we saw coming in at 215,000 for the final week of June, it's near a 5-week low and below expectations, and the data continues to highlight that it's low firing and low hiring. So not necessarily an environment where layoffs are accelerating. Wage growth also continues to remain healthy in real terms, with average hourly earnings up 3.5% year on year, comfortably ahead of the pace of inflation. Broader activity of markets is also backing this up. The ISM manufacturing index registered a 53.3% gain in June, marking the 20th straight month of the overall economy being in expansionary terms. Bearing in mind, of course, a figure over 50 is expansionary. ISM services has also been in expansion for 23 consecutive months. So it's both the manufacturing side and the services side as well. Layer in the historical pattern that we're seeing in from the Wells Fargo chart. From Wells Fargo's analysis, in terms of midterm year corrections since 1978, we have seen positive returns in every single subsequent year following midterms, averaging 13.1%. And this kind of setup looks more like a reset than a warning sign. One nuance worth highlighting, though, the Atlanta Fed's GDP Now tracker has been volatile, dropping from above 3% to 1.2% in the space of just 1 week. But we don't necessarily see that as a reason to doubt the broader trend. And if anything, a cooling but not collapsing economy gives the Fed more room to potentially ease, towards the latter half of the year, if not early next year. Net, this macro backdrop supports staying invested through this volatility rather than de-risking on the back of it. The other element that we want to highlight, of course, in recent equity markets performance, in terms of what we're seeing, in terms of providing opportunities, is the widespread divergence in performance. This chart is actually very clear in that regard. The one line which does stand out, the Russell 2000, marching steadily higher through the year while the Magnificent Seven line rolls over and sits in negative territory. That gap is effectively the story of June. Put numbers on that. The Russell 2000 is up 22% for the year. The equal weighted S&P up more than 10%, and the S&P 493, which excludes the Magnificent Seven, is up more than 13.7%, while the Magnificent Seven stocks themselves are down close to 7%. That's a genuinely rare setup. The market's biggest, most crowded winners of the last 3 years are now in its laggards, while the parts of the market everyone is underweighting, they are the ones that are leading the markets. Microsoft is the clearest illustration of this shift. The stock round tripping that we've seen from a 52-week high at 555 down into the 370s, even as the company's AI revenue run rate surpasses $37 billion, up 123% year on year. It's not a demand issue that we're seeing amongst the Magnificent Seven. It's a spending scrutiny issue. The four largest hyperscalers, Amazon, Microsoft, Alphabet, and Meta, are guiding to a combined $725 billion of capex in 2026, up 77% from the figure in 2025. Market's patience is definitely being tested in real time. For example, Meta's shares fell over 9% in a single session after raising full-year capex guidance to as much as $145 billion. And analysts now are flagging Amazon's free cash flow potentially turning negative this year as it funds its $200 billion AI build-out. Contrast that with the semiconductor supply chain, which the market is still rewarding richly. NVIDIA's Q4 data center revenues hit more than $62 billion, up 75% year over year, and the Philadelphia Semiconductor Index is up over 80% for the first half of this year. Semiconductor sector earnings are projected to grow 131% year on year in Q2. Yet the group still trades at just a PE of 18.4, cheap relative to what we're seeing in the S&P on an aggregate basis and relative to growth rates, which is part of why we're seeing money rotating there instead of the mega cap or the software-driven names. Intel is a great example of this, how far sentiment has swung in the group's favor. The stock has reclaimed levels last seen at the height of the dot-com bubble following its latest earnings beat. The note to keep in mind for portfolios, though, this isn't the AI trend ending, it's the AI trend rotating. Out of the mega cap, some of the software names which are facing capex, significant capex, and ROI scrutiny, the Magnificent Seven, of course, are highlighted here, and into small caps, equal weighted exposure, and the picks and shovels semiconductor suppliers actually monetizing the build out today. Furthermore, I think the chart that is being shown here, the fact set data on the slide, makes the broadening case quantitatively. 6 out of the 11 S&P 500 sectors saw Q2 EPS estimates being revised upwards between March 31st and June 30th, i.e. in Q2, and 9 out of the 11 sectors had their full year 2026 estimates being raised. We're seeing that broadening showing up in price action too. And one of the sectors key that has stood out for us is cybersecurity. The First Trust NASDAQ cybersecurity ETF surged roughly 25% in a single month earlier this year and has hit multiple highs, actually outrunning the semiconductor trade over that stretch, with names like Palo Alto Networks, CrowdStrike among the best performers in the entire S&P 500, as global cybersecurity spending tracks more than $500 billion this year alone. Biotech is another sector which has done well and has broken out. The XBI Biotech ETF returned 16.5% in the month of June alone, one of the best performing ETFs for the month, powered by $65 billion of M&A in the first quarter, the strongest quarter for biotech deal making since 2020. As I mentioned earlier as well, the Russell 2000's all-time high above 3,040 is really the headline data point for breadth. Small caps historically lag until confidence is being seen in the cycle and it broadens. So a record here says something different than a record in the NASDAQ. The one risk to this broadening that we would want to highlight, though, Bank of America estimates that for every additional 25 basis points of a Fed hike, it could shave roughly 2% off Russell 2000 components' operating earnings, since smaller companies definitely carry out more floating rate debt and are definitely more rate sensitive compared to the larger cap peers. Another sector which, of course, has done well, but we do see some potential profit taking coming in, is the semiconductor space, which was the biggest winner of H1. Some near-term, short-term profit taking after such a sharp run is likely. It's less of a bearish call and more of a reason to make sure that semiconductor isn't your exclusive AI exposure. So the bottom line for clients, the opportunity set has clearly widened beyond the previous cycle's winners, but we may see exogenous factors, in particular the rate path that we see this year, still being quite a swing factor for markets, particularly whether we're looking at names like cybersecurity, biotech, and even the small cap sector. And we would suggest holding on to any gains, whether they're possible to hold on to these gains into the second half of this year. So key themes looking at Q3. Looking ahead, the single most important date on our radar is July 28th and July 29th, the next FOMC meeting. But we're also keeping an eye on the minutes from the June meeting, which will be announced today after tomorrow on July 8th. Even more closely for a read on how divided the committee really is in terms of expectations for interest rate direction over the next 12 or so months. It's also worth flagging that Q2 earnings season kicks off in earnest in just under 2 weeks, when the large banks will start reporting their earnings for the second quarter. Given how much of this year's equity story has been about AI capital spending, we'll be watching hyperscaler CapEx commentary and semiconductor guidance as well in particular, as closely as the headline growth numbers. Finally, whilst we have seen the Russia-Ukraine conflict take a bit of a backseat in terms of headline news, we would expect the Middle Eastern conflict to still buffet markets, particularly if any further flare-ups occur. And of course, we have the Israel-Hormuz equation coming into the mix, and whether that does result in supply chain issues, pressure on oil, that only time will tell. In terms of highlights to look out for this week, markets are coming off a shortened trading week due to the July 4th public holiday in the US, so liquidity may still be a touch thinner than usual, even as we move into some genuinely market-moving data. In particular, of course, as I mentioned, would be the FOMC meeting minutes and a fresh initial jobless claims print that will be read closely in light of June's somewhat softer NFP payrolls figure, which was announced a few weeks ago. On the earnings side, this is still very much calm before the storm. The real Q2 reporting season doesn't begin until the following week. So treat this week as more of a macro data focus rather than a stock-specific one. Though if you are looking out for two companies, PepsiCo and Delta, they are announcing their earnings towards the back end of this week. And with that, we would like to conclude the June market review. Please do feel free to reach out to us at Taurus with any questions on how these themes might apply to your own portfolio. Do stay tuned over the next couple of weeks when we'll put out our full second half macroeconomic outlook presented by Taurus's CIO. So do look out for that. Thank you very much and have a lovely week ahead.